Okay, I know this is really hard, but I'm going to ask everyone to find their seats, please. Yeah, you too, Mike Gibson. Thank you, Elizabeth. Okay. I'll have to admit, I got a little worried. Wow, it's not loud? Okay. I have to admit, I got a little worried when I walked through to come into the auditorium and I saw this long line at the bar. For a couple of reasons, actually. It worried me for a couple of reasons. One was, how long is it going to take for people to get through that line? And then the other one was, wow, there's going to be a lot of alcohol in this room. So, by the way, for all those that are not associated with the Federal Reserve Bank of St. Louis, this is not how we live at the Federal Reserve Bank of St. Louis. Only for you. It's only for our guests. It's true. Only for our guests. And then we wring our hands about whether we should do that. So, okay. Well, thank you all, and thank you for your attention. It's my pleasure to introduce our banker keynote speaker tonight, Julieann, or Julie, what a great name, Thurlow, President and CEO of Reading Cooperative Bank in Reading, Massachusetts. Reading Cooperative is a $580 million community bank with 8 branches. And she previously served as a member of the Federal Reserve Bank of Boston's Community Depository Institution Advisory Council. If I just said CDAC, I would have gotten it right. But if I have to say the whole name, it's really hard to do. So, Elizabeth, you guys have something in common. Go share notes about how great of an experience that is. Julie is also a board member of the American Bankers Association and currently serves on its Government Relations and Membership Council. This keeps going on. She's a founding member of Bank Alliance, Inc. In 2014 and 2017, she was named by American Banker magazine as one of the top 25 women to watch in banking. And for the last 4 years, she has been listed on the Commonwealth Institute's top 100 women-led businesses in Massachusetts. Woo. She is the president of the Reading Cooperative Charitable Foundation, and she received her MBA from the Charles F. Dolan School of Business at Fairfield University in Fairfield, Connecticut. And I'm not done. She also completed advanced studies at the Stonier National School of Banking, the Massachusetts School of Financial Studies, and the Harvard Business School's Division of Continuing Education. That's a lot of stuff, Julie. So please join me in welcoming Julie to the speaker.
So thank you, everyone, for the invitation to be here. I've never been to St. Louis before, and now I've seen the Arch. So thank you for just really a prestigious event. I'm really impressed with all the things that I've learned from all the different people today and the information that's been shared and the opportunity to hear perspectives from Michelle Bowman and Yelena McWilliams. And thank you, Cindy Began and Mike Watson. I know that you had some hand in me being here, so we'll take that up later on. I think we're really at an interesting time for our industry, where change is expected from consumers, and it's happening at an accelerated pace. But I'm also very optimistic about our industry, about the opportunities for community banks to grow in new and innovative ways. I love what Chairman McWilliams said this morning about turning ideas into concepts and improving consumer lives. I think this last crisis turned us into risk managers, and now it's time for us to turn on that innovation dial and listen to consumers. So I'm going to share a bit about the Reading Cooperative Bank journey, about our current state of mind, and how some of you in this room actually influenced that. I'll share how we think about CRA and the challenges in the underserved market. And I'll tell you about our emergency loan product, what we hope to do with that, fintech opportunities. We're participating in Alloy Labs. I'll share some of that. And then I'll end on the ABA's core committee, for which I'm chair, let you know what's happening there. And I do have some suggestions for research and where intervention can happen. So if you listen that long, then you'll hear that from me. And I did say innovation, not fintech. I think I'm a little fatigued with the term fintech because I don't think our industry just needs fintech. I think we need financial innovation, which just might be in the form of technology. We need to be willing to think about things differently from both a banker and a regulatory perspective. And we need to think about how we can get better outcomes for consumers. So you probably see a common thread. I'd like to take you along our journey. Oops, there we go, missed a page. So this is a research conference, and I did want to take a minute to give a shout out to some of the researchers in the room and let you know that the work that you do does influence people's thinking. Some of the stuff that came up earlier today spoke to me, and that'll saturate for a little bit. But you do influence the banking industry. There are 3 white papers that come to mind immediately that influenced our institution. The first was the Harvard Business Review article about creating shared value, written by Michael Porter and Mark Kramer. They proposed replacing corporate philanthropy and corporate responsibility with a business case to address societal challenges, finding out a solution, and thereby driving the success of your organization. The second white paper that strongly influenced our bank was published by the Federal Reserve Bank of Boston, and it was The Color of Wealth in Boston. The third was the Federal Reserve's Well-Being Survey, begun in 2014, now known as the $400 Problem. And it was popularized in the article that appeared in the Atlantic magazine entitled The Secret Shame of the Middle Class. So let me take you along our journey, what those pieces of research did for us in pushing us in a certain direction. And maybe we can together think about a different way that community banks can meet the needs of their customers, consumers, and technology. So in 2014, Reading Cooperative Bank embarked on a branding challenge. It was just a simple branding exercise. It was an exercise engaging our employees, our directors, our officers, our community, our customers, just trying to figure out what that one thing that was special about Reading Cooperative Bank. And when you look in the community banking space, and I apologize to the community bankers in the room, but there really is a sea of sameness. We all say the same thing. We provide good service. We care about our customers. We give back to the community. We've all said it. You've heard it all. And even after the crisis, even the bigger banks started saying the same thing as well. And they may have behaved badly, but they got away with saying it. So the goal of our branding exercise was twofold. We wanted to figure out whether or not we should remove the name of the town that we were founded in, Reading, or whether or not we should remove the middle, the cooperative. Do people really know what a mutual is or a cooperative, unless you're in a farming community? So we were thinking about getting rid of that, but we quickly learned through surveying our customers and community that customers really do understand what that means to be a cooperative, and that it makes us different. And it really matters that we retain the word cooperative. In fact, 82% of our customers said that it was important to them, and it's why they banked with us. And in fact, one customer said, instead of being run by stuffy men in suits making millions, RCB is being run by people like me, with a smiley face emoji. And that is now prominently on our walls. And I apologize to the suits. So about the same time, I came across the Harvard Business article about shared values by Michael Porter and Mark Kramer. And in spite of what the Wall Street Journal actually mentioned in the last couple of weeks, we actually adopted shared values 5 years ago. So the Business Roundtable is running a little bit behind us. We understood the value of shared values. In fact, we realized that being a cooperative, that was where we came from, was thinking about what community needs were. So shared values simply states that corporations can be successful by identifying societal problems in our wheelhouse and solving those challenges, and then solutions will provide success and profit for the company because we're better meeting the consumer's needs within our community. That philosophy resonated along with our newfound cooperativeness, and we adopted that as our philosophy for developing all of our strategies going forward. So reconceiving customers' needs, reconceiving products, reconceiving what the needs are, and identifying underserved and unserved consumers in our market. In 2015, the Federal Reserve, and this is a segue entirely because I wanted to share with you, we actually went to the convening that you had in Detroit where Michael Porter spoke, delivering the keynote. We met folks from the city where we are now opening. And I just wanted to share that the convenings do matter. That when you make connections with people over certain philosophy and the opportunity to meet with people with common mind and common vision can catapult ideas beyond what your expectations are. So in this convening, listening, and taking home, it does matter. The second paper that I talked about was the Federal Reserve Bank of Boston's report on the color of wealth in Boston. It was widely reported in the Boston Globe at the time, and let me share with you the stunning conclusions if you haven't read it. In Boston, the typical white household is more likely to own every type of liquid asset. However, close to half of Puerto Rican households and a quarter of US Black households do not have either a savings or a checking account. Non-white households have only a fraction of the net worth attributed to white households. In fact, in Boston, the median wealth of a white household is $250,000, while Dominican and US Black households have a median wealth of close to zero. Non-whites and Black people are more likely to experience much poorer long-term housing challenges and retirement outcomes, largely as a consequence of the lack of their home ownership, housing equity, and retirement savings. The result is that the net worth of whites as compared to non-whites is staggeringly divergent. So it's not surprising that non-whites are likely to experience far more short-term financial disruptions due to their lack of liquid buffer assets. And that's a quote directly from the research and the summary. It's sobering information. And we have to assume that if that's what's happening in Boston, that's what's happening in the state of Massachusetts. And most likely, that's also what's happening in the entire country. And then let's think about forward. Let's fast forward 20 years. So we're all sitting here, and we have our retirement accounts, and we have our financial planners. Our leadership teams, our banking peers, everybody in the room is now retired. And what does the complexion of the working class look like at that point? The people referenced in the report, older people of color in Massachusetts, they'll still be working. They don't have the luxury of retiring with dignity. And that's why your research is so important, because it makes us think, it makes us take the connections from the data that you're putting together for us and apply it to our communities. And then when you look in the mirror, it tells you what you're compelled to do. So we actually asked ourselves, what is a $600 million mutual bank in Boston doing about this problem? And I do think it's funny how old ideas become new again. Any of you who love history, cooperative banks came into existence in Massachusetts in the 1800s. And their purpose was to help working people buy homes. And that was in the late 1800s. In fact, when the banking legislation in Massachusetts was passed, it was second only to Pennsylvania. It was announced in the Boston Herald as the emancipation of the middle class. Because, and I quote, heretofore a man was born and died in another man's home because he was living in worker housing. The S&L movement was the first opportunity for working men and women to own their own home by pooling resources in the form of a cooperative, buying shares in the cooperative. Incidentally, again, a segue, I can't help myself, our first loan was to a woman to buy a home. Her name was Carrie Mace, and we're pretty proud of that. So armed with our history, embracing the philosophy of shared values, and motivated by the Color of Wealth report, we decided to look for financial need in our marketplace and to identify unserved and underserved consumers. Up until this point, we, and I'm sure plenty of bankers, built branches based on consultant research that told us where the wealth was and where the deposits were and where people had lots of disposable income. We opened and offered the self-same products as every other bank. We hired local branch managers and lenders. And at the end of the day, we competed on price, which really is not the smartest thing in the world. There was never a guarantee, responding to the call this morning from a CRA perspective, there was never a guarantee that we would get a satisfactory CRA rating. Rather, we participated aggressively within our community on nonprofit boards. We donated to nonprofits. We volunteered, and we watched for every low and moderate income opportunity to walk through our door rather than going and looking for it. And we would tag them, and we would hope that those first-time homebuyer seminars would generate one more mortgage so that we would qualify in the small bank category to at least meet a satisfactory rating. And in fact, we probably said to ourselves, we're okay with the satisfactory, because once you get an outstanding, the only other way is down, right? So we actually reviewed our branch area, our CRA lending assessment area in contiguous communities, and it wasn't hard to figure out where the underserved markets were in our footprint. It is the city of Lawrence, which has been in the news. It is a gateway city in Massachusetts, predominantly populated by first, second, and third generation Latinos, families from the Dominican Republic and Puerto Rico. Spanish is the first language of 80% of the population, and 29% of the families live below the poverty limit. There exist a large number of unbanked and underbanked families in the city, and home ownership is the lowest anywhere in the state at 27%. This old industrial city has a proud immigrant history. Over the years, its profile has changed as various ethnicities flow through. They migrate in and out of the city seeking opportunity. They come in, they gain employment, accumulate wealth, and then they migrate to wealthier suburbs. So the city stays the same. However, of late, the city has developed its own cultural attraction for individuals of Hispanic descent. There are restaurants, bilingual services, Spanish language churches, island products sold, and Caribbean grocers make the community very attractive to Latino families. The unemployment rate in Lawrence is 8% compared to the state average at 2.5%. The poverty rate, as I said, was 29%, but the county average is 11%. So there's a lot of opportunity for people to grow and have a better financial life. The population of Lawrence at 80,000 individuals is 4 times the population of every other town that we have a branch in. However, there's only a quarter of the competitor banks in that market. There's also a younger demographic. 37% of the population is under the age of 18, and only 8% are over 65. So recognizing that the demographics were different, the same nonprofit FSG, which taught our board about shared values, introduced us to a human-centered design company called IDEO to help us really independently evaluate the needs of a market that was very different than where we were banking already. We had already seen that other banks had dropped the self-same branches that they had outside of the city to no avail. They were really not making much traction. Deposit balances were low. So we brought in IDEO to help us figure out what was different about the market without putting our banking stamp on the community. And it really opened our eyes to the beauty of the city. It also opened our eyes to how expensive it is to be poor and unbanked. So if you are an unbanked consumer, you just got paid, you go into the liquor store to cash your check and you pay 3 to 5% of your check. You step off, you go to the counter, you count out your money because you have some bills to pay. So you step back to the counter and you pay $1.50 up to $3 just to pay your Comcast bill or to pay your electric bill. Then, if you have leftover funds and you want to send money back to your family from a foreign exchange, you can pay up to 10% of that money back in to the same person that cashed your check to begin with. It's the same cash, but there's constant strips of fees that are taken out of your income. And it's not just banking, so it's not just us not banking, and it's not just the liquor store doing this. If you're a recent immigrant or if you don't have a credit score and you want to insure a car so you can go to work, you have choices. You can pay the entire annual premium up front, or you can finance it. You can finance it at 21%. And if you don't pay, your insurance policy gets canceled. So your ability to earn an income is further compromised because you can't get to work. but it's 21%, but nobody's losing money because remember, it's a policy secured loan. They just cancel the policy and get the cash back. So there's opportunity there. Again, there are liquor stores in this city, and I'm sure they're the same because there are no check cashers that I can see in the city of, in the town of Reading or any of the wealthy communities where we have branches, but they are proliferating everywhere within this immigrant city. There are liquor stores in the city that cash over $1 million, closer to $1.5 million a month in payroll checks. And if you're talking about 3 to 5%, that's a lot of money. During one of our field trips, we decided to go into the liquor store and buy some wine. You know what? We must have been the only alcoholics in the city that day because we were the only people buying wine. Everybody else was in there doing their banking in the counter and back. There was nobody else with a bottle at, well, it was noontime. So I guess we should have thought about that a little bit. But on a Friday at 4 o'clock, there are 39 cars in that parking lot. Which, remember the days when there were lines out our doors from a banking standpoint? That's what payday used to be like for us. And it's not just consumers either. Businesses behave this way as well. It's also expensive for them. If you contract for work, if you're a tradesperson and you need to do a job, but you don't have the money to pay your folks until you get paid at the end of the job, you can go in with your contract and your workers will get paid. When the contract gets paid, then the salary is replenished and a piece is taken from the contract and you get your profit, which is really, it's kind of fascinating how it works. And I'm really not here to vilify MSBs. Please don't hear that because they are actually meeting a need that we walked away from. When the new rules and regulatory expectations went in for AML and for BSA monitoring MSBs, the banking industry ran away from these customers and these communities. We cash checks only for bank customers or charging a fee for honest checks. So the MSBs stepped into our void. They provide the service that the banking community was scared away from. And these are private businesses. That's their money. This is not my money that I'm lending out on a day-to-day basis. It belongs to the bank. This is their own money. And so they stepped in the void. It really is capitalism finding the way. But the other thing that we also learned is that immigrants will find a way too, to put food on their table and a roof over their head. But it is at a cost. So not surprising, we learned that today's immigrants are tenacious, hardworking, multiple jobs. They go to church on Sunday and work and dream of making a better life for their families. I mean, seriously, would you really travel across an ocean with your family, not knowing where you're going to put your head to bed, if you didn't have some drive to achieve the American dream? And I have to acknowledge here today my unconscious bias about gateway cities. And until I took the opportunity to be there myself and see and feel and hear the energy and the enthusiasm folks have for where they want to be and where they want their child's life to be, and the opportunities that they're here for, that changed, how I was thinking. So you probably are wondering, I've given you all this bad news about how hard it is for consumers in gateway cities. Why do consumers stay unbanked? Why do they take the expensive route? First, language barrier is a really serious challenge for immigrants today. Poor banking experiences in their country of origin also. And there's also the high cost of making a mistake. And I don't think I realized how our fee structure really is a challenge. If you have cash, you can control it, right? You know if you have money or not when it's in your hand. When it's gone, it's gone. When you have it, you have it. But a $35 overdraft fee at the wrong time of the week, if that could determine whether or not your family could eat, that's a difference. And that would keep you making sure that you don't make a mistake. And when you think about the complexity of the banking system, how is a consumer who's operating and trying to learn another language going to understand what batch processing and real-time processing is, and whether or not a gas station places a hold for double the amount of the charge, and whether or not their paycheck hit first before the charge. A consumer doesn't really get that. And unexpected is not good for a low-income earner. IDEO did a really good job of teaching us how to get closer to consumers, and that's really helped us fall in love with the city and with the people, its vibrancy, its color, friendly, beautiful, smiles all the time. Every focus group has been a joy as we get to know more and more of the city and the people. So our plan has been that we'll open a check cashing business. We're going to pair it with a traditional bank branch and create a financial literacy bridge in between that provides a banking coach and the assistance so people learn how to use the products to best create a benefit for them. I'm going to digress from my remarks, but when you don't have a credit score, that means you're paying the most everywhere. You never get to shop on Amazon when they have their special days because you don't have a credit card to actually achieve that. So you're literally paying at the bodega, or you're not getting the freshest food. And the food deserts are real things. It is a serious challenge in our cities. So now I have to figure out where I was. So we're providing banking coaches, trying to help people navigate and maintain control of their cash. But our long-term goal is to improve consumer financial outcomes and raise the owner occupancy rate. But I do want to, especially since now is a conversation that's opened up about CRA, CRA started in Boston, unfortunately, with redlining. But CRA is focused on home ownership. And there are so many other steps to the financial experience to get to home ownership that we really need to focus a lot earlier in the life cycle. We need to help people get on the first rung of the ladder of success so that they can improve the potential for home ownership and creating that wealth so that they actually have the opportunity to retire with dignity. And the other thing, depending on where you are, what state you're in, and what communities you're servicing, is the learning about the language barrier and the language challenge was a real aha for me. In Lawrence, we are going to be providing services in Spanish. We also learned that there are huge waiting lists for English as a second language classes. And people understand that if they don't learn to speak English and have a better command of English, their financial outcomes and their job opportunities are impaired. But there's a waiting list, so people want these services. So if we can meet them halfway by providing our banking services in a language that they understand so they don't create harm to themselves, get frozen out of the banking system because they had multiple overdrafts, there are ways to create a better outcome for families. And I really think that's customer reinvestment and customer creation. But back to the whole shared value thing, this is not me being altruistic. This is not a nonprofit that we're starting. We may be a mutual, but we are still a for-profit organization. The National Association of Hispanic Real Estate Professionals has research that supports our strategy. By 2030, Hispanics are projected to represent nearly 56% of the U.S. population and account for 32% of new household formation. They're responsible for 81% of the growth in the U.S. workforce, and 90% say in the future they want to be homeowners, not renters. Hispanic Americans' buying power is increasing, home ownership's on the rise, and they are responsible for 62% of net U.S. homeowner gains since 2009. So that's why I'm optimistic about this initiative. There's opportunity there, and we should embrace it, even though it is not the same as our current opportunities or the way we've been doing business. And it was wonderful meeting Lori at Bird and Hand Bank last night and today. What I think is so fascinating as we started talking is there's so many similarities between learning about a different culture, a different group in your community, and they behave differently, but that doesn't mean they don't have the same financial needs. So clearly treating people with respect, identifying the challenge with them trying to do business with us, and adjusting your products and services and your delivery mechanism to meet their financial needs is really a formula for success. So Lawrence is just, I'm going to segue, Lawrence is just one strategy we're working on. For the people in the room that I know, I have 3 kids, and they're millennials, and they behave different than anybody else. And in fact, my realization when they went away to college was that they would never bank at Reading Cooperative Bank. And in fact, they even use their products differently. So they have to bank at Reading Cooperative Bank. I won't let them leave. But they don't have checks. They use Venmo exclusively to pay their bills and pool their resources. And they let just about anybody. I mean, I told them, don't let the gym take money out of your checking account. Push the money to them. But no, they let anybody swipe in and grab money from their accounts. And they really opened my eyes to the fact that we need really, ours is kind of a barbell approach. We have our existing bank customers from, 40 to 60 that love us and think we're just swell. And we have this other opportunity in the city of Lawrence where people bank the way we used to bank. And then we have these millennials that we don't really understand, but we need to figure out. So we have products in testing and development using our kids as guinea pigs. And I'm going to jump to the suggestions that maybe not just a fintech sandbox. How about an innovation sandbox where our kids are in college, they need us to pay the college bill. They would never report us to Consumer Protection. We can use them until they leave and just figure out whether or not the things we think we can do with our products, whether it's improving credit scores, improving outcomes, whether or not we can actually do good things with our products can come about. But we're using our kids for that. So we're working on a credit builder product, a small dollar loan, emergency savings account, and a do no harm checking account. So the sandbox, again, should be used for innovative ideas, not just for fintech. And I will tell you, because we're the regulators in the room, we're really not doing anything wild and crazy. We're just listening to people tell us about the challenges that they're having with our products and trying to adapt them modestly. And look at different delivery methods to meet individual consumer needs. And on that front, we have been working on and have created an emergency loan. I talked to you earlier about 3 different pieces of research. The Fed research on the $400 problem, that also resonated with us strongly. After the research report appeared in the Atlantic magazine, it appeared in the Boston magazine's Atlantic magazine on Sunday. On Monday morning, we have our senior leadership meeting. In walked Maxine, our head of HR, and myself, both armed with that information. And we're like, we should be doing something about this. Middle-class Americans are our employees. So we actually created a $500 emergency loan. It's really not, there's nothing wild and crazy about that. We actually give any employee that says they are having an emergency $500, and we take it back over 10 installments. We provide the loan, no questions asked. And because we're banks, we launched it in a matter of a couple of weeks. The Federal Reserve Bank of Boston introduced us to Build Commonwealth, a nonprofit that's focused on trying to fix the $400 problem. And they actually went and surveyed anonymously our employees to figure out what that actually did for them. And come to find out, it made them feel like their employer cared about them, that the bank had their back. And they also reported that emergencies tend to be closer to $700 or $800, and predominantly for car repairs and medical emergencies. Which doesn't that speak to you that those are challenges that keep people from work, and nobody should ever stress about a medical emergency. The medical piece is hard enough for you to actually stress about the money that goes into that. We should be able to do something around that. So based on the feedback, we actually increased the loan to $1,000. We've actually had 33% utilization by our employees of the emergency loan. And the biggest reward has been the employee engagement. They're proud of the fact that we're taking care of our employees, and they know that, and we know that we've removed the stress around that and improved productivity. And we've actually modified it of late now to anybody that takes an emergency loan. At the end of the emergency loan, you can opt in so that it becomes your emergency savings account, so that you're now saving for your emergency instead of us pre-funding it. And then think about the leverage that you have there. You have 1,000 in savings and 1,000 in loan. You really are lowering the friction point personally for all of your employees. That was a minor employee solution, thinking outside of the box about how we could do it for our employees because of the research you did. And now we're looking at how we can do that for our customer employers, a consumer-facing product, and automation, because automation is necessary because we know the challenges with small dollar lending. You can't get paid enough to cover for the underwriting and the work that's actually associated with that. So we're exploring that space, and maybe you'll see more about that. Again, on the fintech front, we are a founding member of Alloy Labs. It is a partnership of 30 community banks that have come together to innovate together. Our decision to be a founding member came from our own failures. Don't you learn a lot from failures? So I was watching the Super Bowl. Surprise, I'm from Massachusetts, we were winning. Sorry, I couldn't help it. Thank you. And SoFi showed up, and I was, halftime checking in, and all of a sudden I got approved for an $80,000 personal loan. The game hadn't even started up again yet. So I came back in determined. I am the idea person in our bank. Whenever I say I have an idea, everyone ducks. We need to be able to compete with this. They're going to take all of our best customers, is what I told everyone. So we looked at all of the software solutions for small dollar lending, and there are some really creative ones out there, and I was impressed with them. But our team found fault with every single one of them, and that goes back to me saying we're risk managers. The reason why we found fault is because we're looking for how we're going to fail regulatorily, rather than how we're going to meet consumer needs. So we actually brought in FinTech Forge to consult with our board and with our management team and teach us the new methods of innovation. I almost feel like I can throw out my MBA because the new mechanism of learning that's being taught at Harvard Business School around innovation is really distilling the consumer challenge down to the minimum viable product that you can create and solve. And testing and going back and iterating. And that's really not where we learned things. And the way we buy things from our cores now is it's already built out. And they tell you this is what your customer wants. You buy it, you launch it, and you hope. And hope's not a really good strategy. So we joined Alloy Labs, and the goal of that association is we are a cooperative, and is to innovate together and to drive down cost. So there's a couple ways that we're looking at doing that. First of all, we've created work groups around P2P payments, small business lending, customer onboarding, and even core. And as a group, we're stronger together. So we can, there's two ways we can use the lab. We can go out and engage with a fintech to build something for us, and we're doing some of that right now. And what does the fintech get? They get a group of community banks, not just one, of progressive community bankers that are willing to work with the fintech to develop something that fits for the banking industry. And we do it when the code is still open instead of it being already completely built out. So that's one side. And on the other side is we can actually go out there and say we have this problem. There's a universe of fintechs. Let's go out and find the best solution. So that means every single bank is not looking at every single piece of software, yawn, because there's so much out there. Instead, these work groups are distilling to the best solution for the banks based on what they said they wanted, bringing it back, and we're sharing the compliance examination cost by Crow, and we're also sharing the legal cost as well. So it's basically the strength of the group. And then we also represent, as a group, multiple cores. So we have a voice, because we all know the bigger you are, the bigger your voice. And that's a perfect segue into core, which was the final topic I wanted to mention. I think it was Ms. McWilliams that actually brought up in the ecosystem the role of the core and how important they are and critical they are. One more reason that I have tremendous optimism around the industry is my work with the American Bankers Association Core Processor Committee. As chair of the committee, I can share that we are engaging with every core provider, major ones, regional, and emerging, to improve industry collaboration and innovation. The relationship with our cores is symbiotic. One cannot exist without the other. They hold all of our data, but to be competitive, we need access and we need to utilize our data to innovate and differentiate our brands. The committee has distilled through information gathering 3 industry challenges that we're presenting to the core relationships. Data ownership and access. We need data lakes and we need the ability to access our data. APIs, and the most important is contracts and the fairness of those. So we have had constructive dialogue with 4 cores so far, and 3 of the largest, about these challenges. And we're moving forward with our next meeting with fully functional alternate cores that are out there in the marketplace. And then lastly, we'll be evaluating challenger cores to see what is actually on the horizon, what is coming in 3 and 5 years, because there's some significant development happening out there. And then we will be reporting back to the industry on both the current landscape and future landscape. And from my perspective, the core relationship is our most important vendor. We cannot be successful without being able to use that data to the best of our ability. And it's where innovation is best made possible for community banks. So the best outcome for this committee engagement would be to improve the core servicer relationships so much for the banking industry that no banker would ever have to go through a conversion again. And they are so satisfied with their core that they would never want to risk it. And that's really what I see to be the goal of the exercise, but also to let everybody know what else is coming so you actually understand and can negotiate the best contracts for you based on the landscape. So again, to the researchers in the room, there's tremendous opportunity for banks to expand and meet the needs of customers, but it requires, I think, new research and innovation. Help us figure out, and I cannot believe that you put the next set of research objectives for the up on the screen just previous about BSA and AML. We're entering into really a cash-based system when we open our branch in the Lawrence community. And we need to do that because that's where consumers are and that's where the need is. But we also need to look at alternate ways to monitor the risks that are there from a BSA and AML standpoint. So any help you can provide on that front would be greatly appreciated. Consolidations were mentioned earlier today, and I concur with Governor Bowman. We need research around those consolidations. I would love to understand the outcomes. If banks are merging to lower compliance costs, improve efficiency and profitability, we should know whether or not those mergers are accomplishing that goal. That would give bankers better data and an informed decision when they give up their charter. So we are also a very document-challenged industry. And in thinking about where we're going in the city of Lawrence, currently we have tons of deposit account agreements. They're 30, 50 pages long, mostly published in English. And we assume that actually handing that document to a consumer has absolved us of our responsibility of understanding how things happen and how people avoid fees and how they understand that how their accounts are used properly. Does anybody really think the consumer reads the deposit account agreement? Or how about when they click, I accept, right? And I'm not, please do not make us scroll through those pages. I think that would be the end of online banking. But I think research around financial literacy, what do consumers really need to know to properly navigate? We provide financial literacy in schools. We teach people about savings accounts. But are we really teaching them the things that they need to operate about how the money systems actually process, whether or not, as I said before, real-time payments happen or whether or not it's happening in a batch environment and what the risk is for making a mistake. And especially considering how much time we spend on those documents between internal audits, external audits, and examiners just to get it right, maybe we should figure out whether or not anybody's reading them. The other piece of research that I would love, and this is my personal pet peeve, it's Reg D. Money supply research is needed to demonstrate that we don't need Reg D anymore. Limiting consumers to 6 transactions a month on their savings account is just an unfriendly thing to do. And so fintech adverse. There's no limit for the number of Venmo $5 transaction swaps for going to lunch every single day. So we should be encouraging savings, not restricting you from using your savings when you need it. And I think that, and I know the monetary folks will argue for it, but I'll probably say something I'll regret. But I think monetary policy and the money supply is kind of out of the Fed's hands these days, right? So research around Reg D would be really helpful, especially when we're talking about innovating in payments and being able to actually move money around the way people want to move money around. And speaking of that, liquidity and core deposits, let's have some research and that tells us how much of our core low-cost deposits are now sitting on the books of Venmo, Starbucks, Square, PayPal, Amazon. I could go on. But there's a lot of little pieces of money sitting places when they used to sit on our books, but they're on somebody else's balance sheet. And I cannot even imagine across the United States with the amount of Venmo, how about the number of Starbucks people? I mean, my grandmother's in there with the app these days. So, there's a lot of money sitting someplace and it's outside of the banking system. And I don't think we've really been paying much attention to that. Small dollar loans, I know the FDIC did some work in this area, but I think more is needed. As we've been working on our emergency loan and trying to develop products around emergency loans, we've found retail automated offerings from tech startups with an all-in cost of 38% APR at the lowest. Granted, that's better than a payday loan, and consumers are experiencing improvements in credit scores as a result of that activity. But it's still not lawful from a banking standpoint, at least not in Massachusetts. So the competitive angle there is a challenge. So research, I would love to see research in that area. Again, FinTech Sandbox, I loved hearing about the innovation opportunities that are being presented today. I would like to see that innovation goes beyond just FinTech, that we actually start thinking about consumers and then working to the FinTech from that. A sandbox that really talks about innovation first, and going back to utilization of my kids, eventually they're going to become adults and they'll say no to me. So allowing banks to use focus groups to actually pay a consumer to allow us to experiment. It happens in every other industry. And once those test products, if we are using test products and attempting delivery methods that could improve consumer outcomes, we need to actually test them on consumers, not just rats. So that's really the last of my suggestions. Thank you so much for letting me be here. I just want to reiterate my optimism and continued passion for our industry. We're actually very lucky to be in this industry. These are exciting times. I think there's opportunity for us to continue meeting the needs of our communities. As bankers, we need to recognize and embrace the changes taking place in our communities and change with it. There is opportunity in innovation, in rethinking problems and dreaming of solutions based on consumer feedback, all the while making sure we are building and offering solutions that meet today's consumers' needs. The branch we're opening in the city of Lawrence, we believe, will look very much like our branch banks in the 80s and the 90s. Lots of checks and cash and lots of in-person conversations. If we're successful, the next generation from this community will be banking just like the current millennials, and we'll be looking for the next pocket of opportunity. That's what it means to be a community bank, ever growing, ever evolving with the needs of our community. Thank you very much.